Am I audible? Okay. Good evening, everyone. Welcome to today's webinar by the Information Garage or Informative Garage. And today's topic is about pocket money to portfolio. I know what you're thinking. Investing on a Sunday evening? Well, the rest of the world is spending their time on watching true crime documentaries, spending their time with your friends, spending money, and you are here to level your finance game and brace yourselves with a cup of tea, coffee, but most importantly, a pen and paper because today we have the Akashdeep grower with us and we are in good hands, guys. He is a financial GPS who will guide us towards our investment journey, who will take us, who is a lighthouse for all us, the small boats sailing in this articleship journey where we're starting to invest right now. He'll guide us in the right path. But to all the participants who are anticipating the information, let me tell you, he is going to give us so much valuable information. You are going to note all of it down. But most importantly, if you have any personal questions, take all of it, note it down. In the end, we'll have a Q&A session. And in that Q&A session, you can ask all of your doubts. And let me tell you, from the previous webinars, we've heard from participants that as much as the session is important, the Q&A session is much more important because you get to ask your personal doubt. And when it comes to finance, it's like an ocean and it's different for each and every person. And you can solve your doubts in the end of this session. So stay throughout till the end of this session. And saying that, as I already mentioned, we have the Akashdeep Grower, who is a chartered accountant and a CFA, and he has so much industry experience. You're also a prolific investor, sir. You have been a market analyst focusing on mergers and acquisitions, but most of all, we want to know from a student's perspective that what is important, what is that we should look for when we start to invest, especially when our stipends are really so low. Setting that as an introduction, let me pass this session to you. I have my pen and notepad ready to get all the insights from you. On to you, sir.
Thank you so much, Srinidhee. So first of all, thanks a lot for the such a energetic and enthusiastic intro of me. I really feel privileged and glad to be part of it. And the best part, when Karthikeya had a word with me, I was very much excited because this is the right stage. I've been there when I was pursuing CA, right? Yeah, with my stipend money, I was exploring the ways. So I think I'll be able to connect more with this audience. I talk a lot to professionals that maybe at my level of experience or more than that for learning, right? But connecting with beginners at this stage of people is definitely, and I personally think the connect or the impression you set with the people at this stage is definitely going to last long. So look forward to that, and it's really close to my heart. Like I'm able to imparting knowledge or at least learning vice versa from this set of people. So thank you so much for having me here. And yeah, we can straight away jump. One thing, I am we make a lot of boring slides here and there, but I have tried to keep it little interesting for this set of people. And and I want it to be interactive. So if you have any questions, anything in between, feel free to ping right over the view, and at the end of session or maybe in between, if you allow, we can take those questions. More than happy to be part of it. Right. So let me share my screen and please confirm if it is visible. Yep. Is it visible?
Yes, sir, it's visible.
I said like when I started my investment journey, I was doing my articleship and I have bit of kind of energy to invest into stock market from very beginning. Even before when I started my CA journey. And when I did, I was actually looking for some mentor who can guide me, how to invest in that. But I only got the information in bits and pieces, right? Somebody told me, do this, do that. So experimented a lot. That have been my nature, and I came up with a lot of things. I made mistakes. I burnt a huge lot of money at early stages. I was very experimental with my money, and so I want to pass that info. So that you don't have to spend your efforts and money to learn those things, which obviously you can learn from my mistakes, right? So that's why I have kept it like that way. Like, here are the top 5 things, and that I would tell a new investor, right? So we'll jump onto the first slide straight away, and here it goes. I think you must be able to see it now, right?
Yes, sir. It's visible now.
Yeah. So I was like, the first and foremost question, I get a lot is like, when should we start investing? And as I said, the simple answer is like, start small. Maybe, start now, whether it's a small money or, big amount of money you want to invest. And I'll give you a very peculiar example of that. There's Mr. Ramesh, who has started investing at the age of 25 years, say 10,000 per month. And then we have Mr. Suresh, who has started investing 20,000 per month, but at the age of 35 years, right? Double the amount, but he started 10 years late. What do you think, when they reach age of 55 years, who would have more wealth, right? Ignoring everything, assume the same rate of return. Obviously, Mr. Suresh, because he has been investing like twice the amount, right? But the answer is different. Answer is Mr. Ramesh, right? Because those 10 years of initial experience, from 25 to 35, the amount that has been invested at that time has been compounded a lot, right? So compounding is the key. So you all talk about this, like, it's the compounding effect. Your returns yield further returns, right? You already must be aware of how compounding works. It's like return on the return you earn, right? For example, between the age of 25 and 35, the amount they have invested, like 10,000 per month, and the return they have generated on that have also must have fetched some return. So that is how compounding works, and that is the reason you should start early in your life to investing. Don't wait for things. And even from my personal story, and it's not only about money, as I said, it's about learning as well. From the first few investments I have made, right, I might not be able to generate a lot of money, but the lessons I have got from there, I've been able to gather that and employ those same lessons to when I actually started putting big money there, and that has been very, very helpful. And again, in stock market, theory is different, practical is different. I'll personally suggest, if you are interested, go put your money, research. You actually get to learn a lot. So that is definitely the first lesson. When to start, it's definitely start now, even with the small money, not only for the earning purpose but for the learning purpose. So the mantra for this rule or this slide will be, start now for learning and earning. You'll get both, right? So that is the first mantra from my side, like, start now and start. Maybe you can start with a very small money.
వాట్సాప్ కాల్ చేసి లైవ్ లో
Yeah.
మాట్లాడుతూ ఇంకో లోపల జరుగుతున్న కంపెనీ ఇది
Yeah. And like, so I'll take a pause. If anybody has any question, you can put that in chat, and you can let me know.
ఇదే బిల్డింగ్ వీళ్ళు ఇక్కడ
Yes, sir. I request the others to please mute your mic.
అదే
Thank you. Sorry, sir. You can continue.
No worries. Yeah. And you can let me know in the chat if you have any questions. The other thing, next thing is, like, people say, okay, when to start money, start now. But like, you'll find a lot of stocks, people talking about that, you should have invested in that, this is a hot stock, this is something, this is going to be 100x of this current, their current price, this is a good company. Don't believe any of them. Even if me, when I say, hey, go buy that stock, don't believe me. Understand before you invest. Where you are investing, you should be able to understand that. You'll find podcasters like, talking about, hey, I have bought HDFC stock, I have bought this stock, talking about this. You need to understand why you are investing your money in that, and you need to understand your basically the business where you are investing. So it's not only about putting money and getting the return, it's about understanding, because that is the thing, that is a keyword that will make you learn as well, apart from the earning. And obviously, you all are students, you all are growing. Understanding a company is the key, right? So you'll find people on YouTube, Instagram, talking about this. Don't believe them. I have seen a lot of them, are personally pump and dump scheme. They buy stock, they ask retailers to buy the same stocks, and maybe towards the end, they get off, at a very high level, and ultimately it's the retail investor or the amateur investor that gets stuck in those stocks, right? There are a lot of examples. I personally call them hot air balloon stocks, right? Where they are hanging high, and ultimately everybody is waiting for their price to come so that they can sell at maybe no profit no loss, but it never come, right? So DLF is the example, like a prime example of that, or maybe Unitech. A lot of real estate companies is example of that, and then come Yes Bank, right? Everybody is aware of that. People are still waiting. People have bought the stock at 400 levels, and it's trading at maybe less than 50 rupees now. They're still waiting for their levels, right? It didn't come, but and like what should do. So I personally call it 30-second rule, right? So whenever you're talking about any stock, any company, make it a rule. If you are not able to explain, you know, what the company does, or what is the revenue model, what is the business model, don't invest. As simple as that. And this is not peculiar to any specific stock. It's a general market mantra. You have to understand, and you have to explain it within 30 seconds, how the company makes money, what is your growth story, how you will make money out of that. If you can't answer that, just a no. And again, somebody comes to you with a new scheme. Hey, invest that much in that particular scheme, you'll get weekly payments, you'll get monthly payments. A lot of MLM setup we all have must have gone through. So simply ask them this rule, right? Hey, how does that make money? How does my investment will generate money for me? And if they are unable to explain that within 30 seconds in a clear cut format, avoid that. Even if maybe in future I come to you and say, hey, buy that stock, ask me this question. If I am unable to explain that within 30 seconds, ignore, don't invest. And it's not something I have created, it's something coming from Warren Buffett, right? He has his own style. He follow this side, this same rule. If he's unable to explain the same thing within a few seconds, right, it's a simply clear cut no, right? So this is something, understand before you invest, and for that you can follow the 30-second rule to make your investment. And the kind of thumb rule for this, I call it soch kar samajh kar invest kar. I have borrowed it from NSE. I think it's NSE's logo. They clearly say it, soch kar samajh kar invest kar, which means understand and then invest, right? So NSE says it upfront. Still, I don't know people. Why don't people understand, and they chose those penny stocks without any fundamentals and get their money stuck. So you have to understand before you invest. That's the mantra for this. And again, I'll take a pause before moving further. And let me know if I'm going too fast. I have a lot of stories to tell. I can extend it a little.
I think the pace is perfect, sir. Everyone is able to catch up with you. And I think as far as the Q&A is concerned, if they have any doubts, they'll post it in
Okay.
the chat box, and we have a question and answer session.
Definitely. More than happy to take that. Yep. So moving forward. So we have understood, when to start invest. Then, the next part was all about why, right? Because why you should invest in that company. Then we jump onto another thing. People talk about, some good stocks, right? But my, personal experience always says, always check the price tag that you're paying for that, and before that, I'll give you an example, right? I recently went to a market, like vegetable market. I was there to buy a potato, and obviously it's a made up story. So I first came across a set of potato, not really looking good, very muddy, and very small in size. I was like, I shouldn't buy this. I just asked the price anyhow, and the seller said it's 10 rupee per kg. Even though I was not interested in that, those were not good at all, right? I moved further, I found very good potato, straightly saying, they were made for the McDonald's fries. So, that good, golden in color, everything, those were the perfect potatoes I was looking forward, right? And then I asked the price, and the guy said 150 rupees per kg. It's good, definitely, there's no issue with the potato, but it's very expensive. Suddenly I started thinking of those 10 rupee per kg potatoes, and those still can be used. I can make I can maybe fry them and make use of them in some curries or something. Those were not that bad. The crux is everything has to be checked from a pricing angle, right? A stock can be good in fundamentals, but it can't be a good investment sometimes because the pricing is very high, right? So you always have to check the price tag that you're paying, the price you're paying for that particular stock. So that's why I say a great company is not always a great investment, right? And I have a clear cut example for that. Talking from my personal experience, there was a company called Clean Science. It still exists. It's a very good company, and it launched its IPO in 2021. And I somehow had some uh, background information as well because my friend was auditor there, and it was such a great company. With a clean balance sheet, a very good market. It was operating under specialty chemical sector, and good growth prospects. But the stock was being listed at maybe more than 100 P ratio, and that was the catch. Even if I was getting those golden potatoes, but if I have to pay 150 rupees, that's not a good investment, right, for me. And that was the sole reason I simply avoided that Clean Science IPO. And again, you can check Google and you can check it listed at a PE of 100 plus. It went up initially like for a month or two, and then after 5 years, I think it's almost 4 years, it's still trading at the same levels it got listed. No returns at all in the 5 years. Because why? It's not the company is not good, the stock is not good. It's because the pricing they are asking is not good, right? So it's not only about finding a good stock, you have to find a good price for that as well, right? And that's more of a theory. If we talk about how to do that, how to check that, so that is where I come up with the peg ratio. And it's not Punjabi peg that we talk about, it's a peg ratio. And most people have heard about PE ratio, price to earning ratio. Everybody's aware, and I personally think it's very, very overused in the market. If you ask me, come up with a one ratio that we should track, although there's no short answer for anything. But if you still ask me one ratio that you should track and forget all other ratio, that is PEG ratio. I call it peg ratio, right? So here what you do, you start with PE ratio, a price to earning ratio. You try to find the earning growth rate for them. At what rate their EPS or their net profit will grow. You'll find those on company management. They have management discussion and analysis. You'll find that in their guidance at what rate they're expected to grow. You may check certain of analyst report they might have predicted. Get that number, divide the PE ratio number by growth rate number, you'll get a peg ratio number. And as a thumb rule, there's no standard specific hard and specific rule behind this. But if the peg ratio is less than 1, right, it's a good buy. And if peg ratio is more than 1, you need to research further before investing in that. And just to put that into perspective, if a company is trading at a PE of 100 and its a net profit is expected to grow at a rate of 100%, its peg ratio will be 1. It's a very good buy, even though it's expensive, but their growth rate justifies the price you're paying, right? But at the same rate, if you are investing in a company, say at 20 PE, but their growth rate is 2%, you are paying 10 peg for that. That's not justified. So you have to always see the price you are paying, in response to the growth you are getting. So that's, where the peg come into picture. And that's a single ratio that can definitely help you. Once, I was introduced to PEG ratio, and it changed my perspective for sure. Now I don't track PE ratio anymore. I focus on more on the peg side, right? And that's why I say, price matters. And always check the price. How you can do it, follow the peg ratio, that can give you a broader picture. And ultimately, the mantra for this slide is Bhav Bhagwan Che. It's a Gujarati slang for that, which says, valuation is the king. And it's our Guju brothers have found it at very early levels, than us. And I'm just personally fan of this slang. Like, it's not only the finding the good stock, but Bhav Bhagwan Che. Valuation is the king. You have to check its valuation before you, actually buy the stock. Right? So we have talked about when to start investing, You have to understand where you invest. Now, there's another insight. Always check the price tag. Don't fall for shiny, stocks, glittering stocks. Okay, this is going well. This is going well. At what price you are buying? That you should follow. And with this, I take a quick 5-second pause and move to the next slide. Yep. And you can type your questions in the chat. I will take all that up, towards end of the session. And next is like FOMO. We are living in a world where fear of missing out is at, like, I think, all-time high at life, in everyone's life. It's not only peculiar to stock markets, it's for everything, what we are doing in life. And but it's very, very crazy for the stock market, right? People are buying something just because, they think if they don't invest now, they will miss out on the gains, right? And I can personally vouch for that. Even after having, more than 10 years of experience in market, personal investing and trading, you can't catch the market. There will always be something missed out, right? You can't catch everything. There will be stocks that you think you should have bought that could have, resulted in that much of wealth, but you didn't. So, buying in stock, buying using FOMO is a clear cut no. You'll find people around you talking about, hey, XYZ stock has gone 5x. I told you, but you didn't listen. That happened with me as well. I somehow started researching on some stock. I found it good, but its valuation is high. Then I didn't buy it. Maybe after 5 years, I just check. Okay, it has gone further down, further like up in the valuation. I could have bought that, but that's part and parcel of stock market. Once you start investing, you can't beat the market. Like in terms of you can't get all of the market. You have to choose your stocks and stick to that, right? And you will always hear around this chatter. If I would have bought that in that year, that would have been that. Shouldn't matter to you. It's more of a behavioral thing, right? So don't fall for FOMO. Missing out is better than messing up. Ultimately, if you buy using FOMO, you might get in a wrong stock or might get a wrong valuation, and it can mess up definitely your portfolio for years to come, right? So don't follow for FOMO. And I have a word for that. I call it JOMO, and I have borrowed it from someone very special, like a guide who was giving lecture on this, and he introduced me to JOMO, which is joy of missing out, right? So you have to start enjoying the things you have missed out. Now what I say, if people talk to me, say, hey, if you would have invested in Adani stock in that year, you would have that much of money. I counter them by saying, if I would have invested in Unitech stock in 2008, I would have zero money by now. Maybe if I would have invested lakh rupees in Unitech in 2008, I would have 500 rupees in my pocket by now. So if I missed on some good stocks, I also missed on some bad stocks. That's a part and parcel of your stock market journey. And even if you would have listened to Rakesh Jhunjhunwala or Radhakishan Damani, the great investors of India, they would have said the same thing. They only stuck to limited stocks in their life, right? And that is the reason they were able to build so much of wealth. They were not chasing every stock, and we shouldn't do the same. So the mantra for this is FOMO makes you chase, but JOMO lets you choose. So embrace joy of missing out rather than fear of missing out. Yep. So I think we have pretty much covered. So okay, I'll move to the next slide. So we have covered what to do, essentially, and what not to do. I've given you, don't follow FOMO for your investing strategy. And when to do, you should start very early in your life, as early as you can do. And why to do? Obviously, compounding. We have we remember the example of Mr. Ramesh and Mr. Suresh. Why to invest at an early stage in your life, right? And now it comes to how to do. That's the actually very practical insight. Like at this stage, at what you are very nascent stage of your career. You're just making it up. So at this stage, how you should start investing. For me, if you ask me how I invest, I obviously do a very deep dive research of everything, checking their valuation, checking their business model, as I told you. But I personally think that might not be possible for everyone, maybe due to lack of time, because you have to devote your time towards studies, or maybe due to lack of knowledge to that level, right? You might be able to might not be able to spend that time, or maybe you might not have acquired that level of skill now to analyze those. So but I have a practical experience, and that I definitely learned from my mistakes, right? So that I call it the silver bullet approach, right? So it's essentially, so what I say, keep a track, where smart money is flowing, right? So track where PE firms are investing, where FIIs are more investing, where DII is more investing, like institutional investors are more investing. I particularly, in my life, I started following this from a PE firm. So I used to work for a private equity firm, and I just get to know how diligently they work. So we used to work for years before the firm make a decision to invest, and it has to go through a level of analyst, then principals, then their VPs, then ultimately investment committee. So it has a rigorous level of research before they input money any of the stock. So while private equity firms are mainly investing in a private sense, right? But still, there are a lot of private equity firms which invest in public equity as well, right? So I was working for a private equity firm, and I was keeping a track of where they're investing. And at that time, I just a news occurred, like one of the private equity firm has invested in Himadri Specialty Chemical, right? So that used to be, I've never heard of that name at that time. I just picked the stock. I started researching about it, and it was time, and it was maybe 2018 or 2017 pre-COVID era I was talking about. And I did a bit of research. I found the company good, and I had a conviction because how private equity firm they were investing in that, and I was pretty sure because I was part of it. Like if they are investing, they must have done a rigorous research, right? So they invested in Madhu Specialty Chemical. I just put my money along with that, and you should Google it and research how it went well. It made my money 10x from the levels I invested in 2018 or so, and like within 4 or 5 years, right? And that's the simplest approach you can follow. So rather than simply putting your money where your uncle's neighbor is telling you to put, just follow the where the smart money is flowing. Do your research a bit, but if you don't have time, if you don't have maybe that skills right now, you should follow the smart investors, right? But again, this comes with a question. It's a guide, it's not a guarantee. It can definitely replace the deep dive research essentially, but definitely if you want to experiment, you should go with that. That's a very practical insight from my side, right? On this part, just track them, make a list, try them, and put your money along with the smart investors, and you will definitely end up with a good money. I can bet on that thing. So with this, the mantra is simple: follow the smart money, right where they are flowing. So these are the five basic rules I would have actually you know uh, I would have wished somebody has told me when I started investing, but it somebody didn't, and I get that in bits and pieces. So I'm just passing it on to you. These are the five things I would tell new investors. Like start now, start early, understand where you are investing. If you don't have time or skill to do that, just track where the smart money is flowing. Don't follow like FOMO, fear of missing out. Focus more on joy of missing out. And lastly, always check the price tag where you're investing. It's not only about finding the good stock, it's also about finding the good entry level for them. So those are the five slides from my side, like five key mantra from my side, and I'll pass it on to the team.
Yes, sir. We have got five bullet points for us, guys. I think we would use this, and I really loved all the little lines that you used in between. So, like valuation is the king, and missing out is better than messing up, and all those things. So, it is the time that you're waiting for, guys. The Q&A session. If you have any questions, please put it in the chat box. And so we have the first question already here. Can we start with the Q&A session?
Definitely, all up to you.
Yes. So we have Anisha Tiwari asking, as per the current situation, what will be the right spot to invest?
All right. So obviously, I can't name any stock as such, right? But I personally think market is valuation is little stretched as per me, and either market will maybe take a little correction from here, or it can stay at the current levels, maybe not yielding return as market was able to yield in last 2 or 3 years. And again, when I say market correction is expected, doesn't mean it will correct 30%, 40% from here. Right? That might happen. That's a different scenario. But understand one thing: if market is staying at a same level for 1 year, right? It's not giving you, for example, Nifty is still trading at 24,000 levels. It's still a correction. Earnings are going up, but the pricing is same though, so the PE ratio is coming down, right? So I personally think market we should wait for the earning session that is happening right now, and with the earning session in place, with the fundamentals checking again, I think then we'll be able to answer like what is the correct entry point. But yes, at this stage, if you want to invest, I think blue chip stocks or the large cap stocks are definitely first to look forward to. And from my experience, what I've observed, it's always the blue chip stocks or the large cap stocks that start running first, and then followed by mid cap and small cap.
All right, all right. Guys, I hope you're noting it all down because these are gems of information that we have to take notes of. And with that, just a minute, sir. People who are online, I'd like to tell you that the slide that sir presented to us will be sent to each one of you personally. So I ask you to stay till the end of the Q&A session because after that we have a quiz session also in which if you win, you will be awarded with special surprises. Okay? So with that, sir, moving on to the next question. As we keep investing, at what point should we assume that we are in for options trading?
Oh, that's a very tricky one, and okay, I have to think through. So I personally think going for FNO is altogether different game. It doesn't go like this. If we have made that much of money in long term investing or fundamental investing, you are ready for FNO as such, right? It's a altogether different game. It's like playing cricket and football. Even if you are Virat Kohli in cricket, it doesn't make you suitable for football as such, right? So a different game altogether. You have to understand its dynamics. Fundamental investing is very much different from FNO. FNO has a very high burn rate, I'll say, and as per the recent data published by Siri, I'm not sure exactly, but they said around 90% of people are losing money in FNO, at least retail investor when it comes to retail investors. So you have to understand that. I personally do that like for my own purpose, but I take I don't recommend it for to anyone like jumping in without any knowledge. But again, to your answer, it's altogether different game. You have to understand its dynamics in a different scenario before you jump in. Just your experience with the stock market, like fundamental investing, doesn't make you qualify for the FNO as such.
Okay, so we get market is always subjected to risk, so we be careful while we read the documents. Okay, we have the next question by Harshit. How do we get reliable information about the smart money that you were suggesting about from the PE firms? How do we get reliable information about which firm is investing where and what do the firms look out for? Since you were in the firm, you knew about it. So how do we know in general how do the PE firms look for what?
Got it. So just to clarify, I didn't invest. My firm where I was working didn't invest in any stock. It was a altogether different firm, right? So my experience just tell me about how private equity invest, right? How rigorously they research before investing. That was my takeaway from that, right? So you have to track. The news are all over media when they invest, and nowadays you'll find a lot of apps and websites where they have screeners for that. Where FIIs are investing, where private equity firms are investing. But there's no single source to that. Just keep your eye open. Just keep looking for those things. Those things definitely flow through media, and you can track some of the press releases from private equity firms. You'll definitely get the names. You can add that to your watch list, and it'll be in your portfolio then.
Okay. Okay, so moving on to the next question. What should be the strategy while investing in SIPs or mutual funds and how to pick the right one?
SIP and mutual fund. So I had a very different opinion on mutual fund. I personally think mutual funds are very much overrated in India. It's maybe due to the uh, catchy tagline
Marketing.
mutual funds sahi hai. Like I personally think I think people treat mutual fund like anything. If they start doing that, they'll make a lot of money. That might look theoretically good, but practically I'm not a fan of mutual fund. Again, when it comes to mutual fund, you have to understand which mutual fund, right? It's not a one-stop solution, right? It's like going for a platter. That is fine, but you ask for a platter and they ask, okay, which platter you want? You want North Indian platter, South Indian platter, continental platter? You have to choose, right? It's not a solution to everything. So I I personally don't invest in mutual fund as such. I focus more on getting specific stocks out and invest in that. Some of the mutual fund I use is like to invest in US tech funds where I directly can't invest. For example, I want to invest in Nvidia, right? I am personally fan of US tech companies. I do that through mutual fund, which they are US tech equity mutual fund by Motilal Oswal or something, right? So I invest in those. So I I can't recommend anything on mutual fund as such like entry point because I'm personally not a fan of. I just can convey one thing. First, try to invest in stocks directly. It saves you from a lot of things. Second, even if you're a fan of mutual fund or want to invest, just do research. How your mutual fund has performed before that, and only then you should go for it.
Okay. Can we tell these five things that you suggested for stock can also work for mutual funds, sir?
Definitely, spot on. You bring in very, very valid point. So, uh, I think people assume mutual funds are a solution to everything. I think they are just like as stock with a lot of diversification, right? So, again, even if you are choosing for mutual fund, you have to do all the things, right? And there are a lot of downside for the mutual fund as well as compared to stock. There are a lot of sometimes there's a lot of diversification, right? If you talk about people like maybe Radhakishan Dawani or Rakesh Junjunwala, they were not buying mutual fund as such. They had a portfolio of 25-30 stocks, right? Because only those bets can earn you more money rather than diversifying across hundred of funds. And if you want to diversify a lot, then I will suggest go for ETFs, right? Those are exchange traded funds which basically follow some index, right? Maybe Nifty or Sensex. You can invest in them, and obviously they don't charge money for managing, right? Which whereas mutual fund is charging a lot of money for that. So I think ETFs can be a good substitute for mutual fund in that case.
Okay. So you mean to say rely on yourselves rather than relying on mutual funds?
Definitely. And at least even if you are trying to rely someone, just do your research before jumping all in.
Yes, sir, definitely. So next question is finding an exit point from the market is so much more difficult. So how do we find the exit point? Because entry is easy, but how do we find when to quit?
Definitely. I think I personally think that's more of a behavioral challenge, right? Whenever you are earning money, your heart will always say, I buy to sell now, it will go up to, maybe double from now. Or vice versa. If you are losing money, you might end up saying, okay, at least it should come to my break even price. I don't want to book loss in that. That's more of a behavioral challenge. So to answer like how to do that, I think you should fix rules for that. I personally have I call it a 25-25-25 rule, right? And how I explain is uh, whenever I think any stock has reached its fair value, I book 25% profit on that. Then I put a stop loss. I let it go because sometimes some stocks are in momentum. You can't exit all at once, and then they go on and on, right? Then I book 25% profit, and then if it continues to rise, maybe 10-15% more from that, I book another 25. And if it continues further, maybe 15-20% more from that level, I book 25% again, and that's the hard stop for me. I never get that another 25% out. I always keep invested myself like at 25% level, unless and until the fundamentals are very wrong, there is fraud with some company. But I always remain invested like 25% of my money in that. And that's what I did in last year only when the market was 26,000. I was out like 75% of my money from the portfolio as such, and I've shifted my funds towards gold and some of the debt funds. And but 25% I remain invested, and I have my money ready. Whenever I get a chance, I'll invest those back into this.
Right. So that is your key for your exit point, guys. That is more like a behavioral pattern. Is that what you said, sir? Yes.
Definitely. And
Okay.
just to you put that into a single sentence, just follow a hard and fast rule for that exit. If you start thinking at every level, whether I should exit now, you should set your levels in advance, right? Your exit strategy should be set in advance, like when you enter, at what level you want to exit, and follow that. That's my advice.
Okay. Okay. Moving on to the next question, sir. What do you think of the PSU stocks in the long term? Many stocks like Titagarh, HAL, BHEL are much down from its superior level. So, should we be holding or selling for better opportunities? This seems more like a personal stock question.
Yes, definitely. Somebody is asking for a stock advice. Okay, so I'll tell you again. Putting all PSU under one bucket is not justified, right? You'll find PSU banks there, PSU maybe Navratna companies there. Then there is HAL. So I personally not a fan of PSU stocks as such. I think whenever there is a regulatory measure over there, that is a hindrance in its stock price. For example, when it comes to bank, there used to be Vijaya Bank and a lot of small banks. Without their will, without the investors' consent, government has started simply, merged a lot of banks there, right? And that where shareholders' will was not involved. So there, sometimes there are regulatory challenges with these kind of companies, which is not in hand of investors, right? So I personally avoid, investing in PSU stocks or any of the stocks where regulatory measures are very stringent, right? But again, there that's my strategy. But there might be some tactical opportunities. For example, HAL. Recently, there has been a lot of talking about like defense stocks, right? Maybe Paras Defense or HAL for that matter. So even if it's a PSU company, but the story plays in, right? So if defense budget is increasing, it's gonna go up, right? And so that becomes a good tactical buy for me. So I, rather than taking it as a whole bucket, right? PSU stock I avoid, but I look for specific opportunities within those PSU stocks. And another point is about dividend. So they pay very good amount of dividend, and I personally keep a part of my portfolio investing in those dividend stocks. So where the market goes up and down, like at least I get some money out of that for sure.
Okay. So, you divide and rule. Put all your money in divided parts. So, you can take it out
Definitely.
easily.
Definitely. You always have to, choose different measures. You never know stock market, and some of the folks who have joined stock market after maybe 2021 or so, they haven't seen the correction when what we saw in 2020. The portfolio were halves and every stock was down, right? Right, and that pain is like at a different level. So like my only point is never put all your eggs in like one basket,
One
and for my
basket.
vegetarian friends, like your all potatoes in one basket. So I don't suggest. Always try to allude to different type of asset classes no matter what.
Diversifying.
Definitely.
Okay. Next question. So, what is your opinion on Bitcoin? Because Bitcoin supply is fixed.
Actually, I personally think I'm not an expert in that, so not a perfect person to answer that. And also because I'm jealous, I couldn't invest. That's why I'm saying. But I think crypto in India, I don't see it as a good investment opportunity because again, my rationale is simple. Uh, Government might declare it illegal any days. That has been a rumor a lot of days, right? So I personally don't think we should invest. We should get more clarity. And I'm of opinion, like if there is a good opportunity, even if you're buying maybe at a later stage at a higher price, but if you're more convinced, then that's a more viable option than buying now in FOMO, right? And so that's the reason. That's my take on the crypto. And but within the crypto, if you want me to suggest one thing, that's definitely Bitcoin. So guys, don't go anywhere. If you are very much willing to go for crypto, Bitcoin is the only option.
Okay, sir. All right. Moving on to the next question. Is it a good opportunity to invest in drone manufacturing companies right now, especially after Operation Sindoor?
Why didn't you ask me before the Operation Sindhu? I should have said yes, definitely. But do you know how the prices are right now? You should check, prices for Paras Defense or maybe HAL, like we already mentioned. So prices have already gone up. I think that that particular kind of euphoria is already reflected in the prices. Again, you have to emphasize, and again, I think that's more of a FOMO question than a real one. And you should talk about, what will go up next. What's next. Maybe it's our navy making the next strike. You should invest some navy in navy stocks or so. So think in future rather than just getting stuck on the in the past. But again, I have to you also have to reassess, whether what valuation they are trading in, and do you think they can go up from there. So you can check their peg ratio and make a decision.
Yes, sir. Remember, guys, FOMO is not a strategy, and this is clearly FOMO. What valuation principles need to be taken for investing a stock as a beginner? So, like, what valuation principles need to be taken for investing a stock as a beginner?
Okay. So if I start listing down, list of ratios you need to track, or different kind of measures, there's no end to that. You start with one, then you start with P ratio, then there's ROCE, right? Then there's ROE. It's always, n number of ratios that you track, and it's not only, what you already know. There will be, new ratios coming up daily. For a startup business, like, or for an e-commerce business, there will be altogether different set of ratios. So there's no end to that, but I think I have already conveyed my point. If you want to stick to one ratio, I think that will definitely be PEG ratio. You need to get the PE ratio, get the growth rate divided by that, and that should be your for criteria for selecting a stock. And again, that's just prima facie, and it can't replace the value of detailed research. But if you want to go for one ratio, that's definitely PEG ratio.
Guys, he has already mentioned about the PEG ratio, and he has currently told us how to calculate it also. So, PEG ratio, that is a go-to ratio to invest in a stock. The next question is: is it good to invest in intraday market? I currently market position. I'm sorry,
I think,
Anisha Tiwari. I think you need to make your question much more clearer.
yeah.
Meanwhile, sir, since you already spoke about ETF, which one would you suggest, like gold ETFs or SGBs? Investing seems pretty fascinating, but which one it is?
Asking a specific thing about this is like define the whole purpose of this, I think, webinar. My only
Okay.
lesson from this has to be you have to research. Gold ETF is nothing, right? You have to assess, whether you think gold will go up from here or not. And same way how, gold ETF will behave, right? I did invest in gold. I sold my, 75% of my portfolio. I was able to sell that last, I think, October, and then I shifted my money to gold. I just can vouch for one thing: I'd made good money in gold ETFs. I'm not sure how it's going to perform from now or not, but that was the right time to ask that question. Maybe 1 year back. Uh, I don't recommend going all in for gold ETFs as of now. You have to assess the scenario, how it goes, how market behaves, and how the geopolitical scenarios turn up, and that's why you can talk about gold. I can't give a yes or no answer on that.
Okay, sir. So the next question is, right now we're article assistants and we have a monthly SIP of 1,000 rupees, and assuming our current stipend, like average stipend is 5,000 per month, how much should I invest in stock market? Like how much will be the safe amount for me?
Okay, definitely. So again, at this nascent stage, it doesn't matter how much you invest. Like for example, I told you the amount I invested when I was pursuing my CA and I was getting only 3,000 as stipend. Those money didn't earn me big money, but those earned me big lessons, right? The money I have burnt in wrong stocks. I'll give you examples. There was a stock called soya protein. I started going to gym and I said, okay, there's a protein in that stock. Why shouldn't I buy that? I put money on that without even understanding, how that works, what the company do. And ultimately I lost all of my money in that particular stock, right? It didn't earn me any money, but it did earn me a very good lesson, which I'm conveying right now. You have to understand where you invest, right? So the money you invest right now might not earn you a big chunk, but the lessons you learn now, and there might be more lessons. Obviously, you'll have your own journey. You will make your own mistakes, and you learn your own lessons. So that will help you to grow your money whenever you have big money to invest. When you are settled, when you have more money to invest, those lessons will definitely help you to grow, right? And compounding is not only in terms of returns only, it's also in terms of learning, right? So I will suggest do whatever you can do. Don't chase money. Go for learning. Once you are able to learn, you will definitely able to earn from that as well.
That is really a good lesson, sir. We first start learning and then start earning. And sir, there are so many courses and like about stock markets and all those things. So if I am looking for a course, which one would you suggest? Which course can I choose to learn more about stock markets?
Okay. Uh, I don't suggest any course. No course can teach you stock market, right? It's just your curiosity, your will to learn, right? And I don't believe, I don't follow, there are still, people going for courses to learn stock market. You should practically go for that. There's a hell lot of knowledge on even freely available on YouTube, right? Go search that, have a open eye to research whenever you hear about any stocks. So next time you talk about any stock, just try check their valuation, at what valuation they are trading. You see, you hear about any IPO, go track them, try to learn more about it. You hear about any mutual fund, go track about it. That's how you learn, right? Even I'll say, but basically fundamentals I learned during my CA are very less relevant to practical knowledge. The lessons I've learned with putting my own money, making mistakes, burning my own money, they have taught me practically more than my degrees. So I don't recommend or don't endorse any course. I just think having a curious mind to learn, and then knowledge is everywhere. You just have to have an open eye.
So experience is the key for investing.
Definitely.
So that's it. Okay, we have another question. Do you follow a structural template for fundamental analysis? Any qualitative framework that you use, if you can suggest us?
Definitely, I do. So it has a lot of ratios. It's not a single ratio. And I can't list it down. I check their valuation metrics, how they are trading. So let it be P ratio, EV by EBITDA ratio. Then maybe check their cash flow ratios. That's very crucial to me. How is their operational cash flow? Their financial cash flow. Then their profit margins. There's no end to that. And then their growth rates, right? What are other analysts expecting? So I have a whole full methodology there that I follow. And again, those are quantitative factors that you can put in numbers. And then there are certain qualitative factors, how management is putting guidance, what is the execution track of their management. Sometimes a stock might not be that good, or maybe, fundamentally okay, but their management is so strong. They have a very good vision. And it comes to my mind, Markson's Pharma. I invested in that stock solely based on the vision of their CEO, and it turned out very well because that guy was very much willing to uh, take it to a next level. And the vision was the one thing that actually attracted me to that stock, and I made good money out of Marks and Pharma. You can go Google him, check how its share price increased. So there is set of quantitative as well as qualitative factors that you need to follow. You have to follow a story, and you have to have a reason why the stock will increase from here, right? This will give you that, but I follow a detailed approach. I can maybe in a separate topic I can share a detailed method I follow. It can't be summarized in a sentence or so.
So that is a sum of like a cumulative experience summed up into your investing practice. That I can put it like that. Okay, so
Definitely.
the next question is, which one should we prefer investing in, real estate or gold investment? Stocks to real estate or gold investment?
Okay, so again, I think at this stage you should focus more towards stocks, right? Even though gold has outperformed stock market, I think for this year, for past many years now, because gold prices has risen, right? But that is mainly due to the geopolitical tensions across the world, wars going on here and there. So that's the reason gold goes up. But ultimately, it's the stock market. And while I was pursuing CFA, so there's a rule, they call it 120 minus your age, right? So that much you should invest in your equities, right? For example, if I'm 30 years old, I should invest 90% in equities, right? And if you are 20 years, you should invest 100% in equities. If somebody has reached the age of, say, maybe 80 years, they can go for, okay, 40% equity, 30% gold, maybe that, right? Because it's, I told you, it's all about compounding, right? So the early you invest, start investing, you learn, the compounding will work in your favor, right? It might not get you good money in first few years, definitely, but in the long run, you will accumulate a lot of money, right? So I personally think stocks should be your first preference. Second, it's a behavioral aspect. Like our families, already had some investment in real estate and gold in some shape or form, right? So don't consider it, separate from your wealth, right? It's part of your wealth anyhow. So I personally think, people say, okay, should we invest in gold, ETF, or real estate? I say your family has already invested in real estate and gold. The only thing lacking is stocks. You should try and go for that.
Okay, sir. Got it. And okay, as an investor, how do we manage emotions like fear and greed in investing?
There's always a tug of war going between fear and greed. And trust me, if you are able to manage that, you will succeed in the market for sure. And as I tell you, FOMO is part of kind of greed metrics only. So you know once your stock has gone some price up, you'll start feeling like, okay, it'll go, maybe double or triple from here. Why should I sell? And when it goes down, you always started feeling, why should I book lows? It will come down. You'll start feeling emotionally attached to the stocks. So this will always happen. It happens with me still now, right? But how I try to tackle is, as I told earlier, like before entering a particular stock, I have an exit strategy in place, right? And I follow it like anything. If it is reaching at that level, I'm selling my 25%, then 25%, then 25%, right? And if it is going down, that is my stop loss. That's it. I simply stick to those rules. I even, when I buy, I put that in the app only. If it touches that level, I should sell that. And again, we all are students of finance in some shape or form. I think you must be aware of the sunk cost fallacy, right? If you have lost some money in anything, it's already gone. That shouldn't be part of your decision going further. If I bought a stock at 100 rupees, it's trading at 50 rupees. I'll assess it now, if it is worth 50 now or not. Shall I invest? Shall I continue or not? If it is not worth investing, I'll book my 50 rupees loss because it's already sunk cost, right? Don't get emotionally attached to those stocks. So that's my thing. Like, focus on execution, have your exit strategy in place even before you enter. Let it be a profit or loss, and this should help you.
Okay. So you said you use an app. Which app do
Like,
you use?
like normally for like my broker app, that is what I was referring to.
Okay.
Yeah. Like, so I was saying, when I buy a stock, there are options, you put a condition like I'll sell it when it reach at that level. Maybe, putting a stop loss for the loss and then putting a target for that, in long term. So I do it upfront. If it reaches at that level, maybe in 6 months or 1 year, it automatically sells. It automatically sends me a notification your stock has reached at that level. Would you like to sell? So I simply sell it.
So that is very safe. Just a minute, sir. We have a next question. I think it's at your perusal. So if you want, you can answer. Stock ETF or industry ETF, which one is best?
Okay, interesting. Again, there are two approaches to investing. One is top down, where you start with the broader industry and then you delve into specific stocks, right? And then there is bottom up, where you start with a particular stock, then you assess its industry. There's nothing wrong or right in this. Both approach work well, but you have to come up with a your story. Essentially, why are you investing in that? And while I'm personally a fan of bottom up approach, but I don't deny the top down approach as well, because a few years back, we were working on semiconductor in the US, semiconductor companies in the US, right? And it occurred to me, semiconductor is the next big thing, and it's, I think, 2021 or 2022, right? At that time, India doesn't have semiconductor things as such, only a few listed companies. And that too, I was unable to find those companies even after doing a lot of research. Their website was not good. It was not investable. But I was very much convinced about semiconductor. Right? At that time, what I did, I found four companies I was not sure about, and those were loss-making companies. I simply put some money in all those four. That's a top-down approach. I was basically investing in semiconductor industry and not particular stocks. And you have to believe me, it has gone 10x from there, at least every stock, because the semiconductor industry was going to boom anyhow. Because I was working in for industry, I was it's going up in US, it's going up in Europe, India will definitely come. and now you start hearing a lot of news about Foxconn is getting into joint venture with this company, and there are semiconductor plants being established in India. So that was an example of top down approach. So there's nothing wrong, you can try for both. You have to come up with your story why you're investing in that.
So you use the general information and the trend, and you predict the stock's price, and you invest accordingly. That is how you do it.
Definitely. So I normally do stock research and then check their industry, but this time it was vice versa. I just bet on semiconductor industry. I found four stocks in India. I put equal money in all of the stocks and all worked well. Some has gone maybe 50x from their value. Some has gone 5x, but on an average, I think 10x has gone. And I can name a few. I think one it was RIR, right? They were very small companies at that time. Then there was Most Chip was there. Then there was ASM International. So these were three or four companies. I was not even aware of how they were performing. They were loss picking companies actually, but I was very much bullish on the industry. So that's why it made me money out of that.
I think you got your answer, Vishnu. Research is the key. So research as much as you want, and then invest in that. We move on to the next question. I am sorry. Is there any opportunity you? Oh my God. Is there any opportunity you see to leverage stock market analysis and advisory through AI?
Okay. I think AI is definitely going to haunt you and me anyhow, even if we say no to that. And I can only see there are some startups, talking about they're leveraging AI into stock market. But I am personally not in favor of using AI for stock research as such. You might use it for bringing in some facts or bringing in some analysis to you so that you can make an informed decision. But leaving the decision to I think that's not the wiser approach. And another thing is something, in stock market you have to beat others. Basically it's all about how to beat others. If everybody is using AI, everybody is getting the same results, everybody is performing at the same level, you won't be able to beat the stock market, right? And you
Exactly.
won't be able to beat the market, then there's no point of being in the market. So to answer, yes, you can use AI to get more of information about around the stock you are researching, and then you can make an informed decision. But you shouldn't leave the decision to AI, like which stock should I buy. I think AI can't do that.
Okay. Okay. So got it. So as an early investors, how do we strike the right balance between saving and investing in an early stage? Uh, when to out from a holded stock as a profit booker, and how to acquire stock at valued price?
So are these two questions, saving and investment, is different? Like it's the one question altogether?
I think those are two questions, sir. We can answer
Okay,
separately. The first
so
one,
I'll take
balance between saving and investment.
got it. So I'll take first saving and investment. So I think saving is not a thing anymore, right? Who will goes to bank and deposit their money? I think you'll ultimately inflation will eat up all your portfolio anyhow, right? So I have a personal rule. What I do, I keep I call it emergency fund. Maybe maybe 1 year of my expenses or maybe 6 months of your expenses, depending upon how what are your level of expenses, right? Only that much I keep in my bank account, right? Rest I all invest, because nowadays investing is not like you have to wait for months to encash your money. Even if I am in utter need, I have 6 months of emergency fund or 1 year of emergency fund, and I get to get more money beyond that level, I can simply get that on next day, right? Nowadays you place an order, your order get placed within T plus one, like trading plus 1 day, your money gets settled and credited to your bank account. So I don't see the need of savings as such now, but still, as a prudent practice, you need to keep some emergency fund. But otherwise, you can get rid of saving thing from your mind altogether. That's a thing of past now.
So even as a student, we don't have to save much, and we can go on investing other than the savings fund we have, like 6 months fund.
Yeah, you should keep your emergency fund. Then you should start. Maybe when I say investing, it shouldn't like all be in stocks, right? It could be anything. But if you have your risk appetite very low, you can invest in some maybe large stocks only. Don't go for penny stocks. Don't go for small cap stocks, right? So that again, investment has to be done as per your risk appetite. I'm assuming that is already done. Apart from that, you don't have to keep your saving as such. Apart from the emergency fund that I'm talking about.
Yes, sir. I
And then
think
there
we
was
heard
a
you, but your video was a little lagging.
oh, all right,
Okay. But we
okay,
heard you.
okay.
So we have the next question, like the second question, sir. When to out from a holded stock as a profit booker and how to acquire stock at valued price.
Sorry, I didn't get you. Your voice is little sketchy. Please come again.
Sorry, sir, your video is stuck again.
So I'll pause it now. I'm unable to hear you. Can you please repeat the question?
Am I audible now, sir? Is it clear now?
It's little shaky. I think I can understand.
Okay, sir. When to out from the holded stock as a profit booker and how to acquire the stock at a valued price.
Okay, I get it. So basically, as a profit booker, I've already given you my exit strategy, how I exit, right? And it's I call it 25-25-25 exit strategy. And again, it's not a hard and fast science for that. You can have your own exit strategy, however you want to do it. So the key is having an exit strategy in place before you enter, right? And just sticking to your exit strategy. Don't get your emotions sway you into not selling now. Just stick to what you have thought. That is how you can emerge as a profit booker. And second question, I think other thing was about how to be a value investor, if I heard it right. Am I right?
How to reacquire the stock at a valued price.
Got it, right. So if you have exited a stock, and that I do a lot, right? For example, Marks and Pharma, I was telling you, I did exit, that stock after it has reached my fair value. At the same level, I set some level, okay, this is the valuation, right? Now, either the stock price has to come down, if it has gone far above my fair valuation, but I think, or it has to wait, the earnings has to grow. So ultimately, PE ratio has to come down to a certain level to in order for me to make a buy in that particular stock, right? So I set a bar on PE ratio, and that has happened with me for the Marks and Pharma. I sell the stock at a certain level, then I waited back. It corrected a little, it re-entered my buying area, and then I entered into the stock. Even if it didn't, that's not a issue for me. For me, exiting at the right level, at the same level, I set the buying level again. If it comes to, now it's trading at 250 level. If it comes to 150 again, I'll buy, right? If it comes, then it's a buy for me. I'll buy again, then I'll make money again, then I'll exit, right? So I set those rules up front. And for example, if it doesn't come again back to 150 levels, then that is fine. I have another stocks to explore and earn money. It's not only the one stock that I'm chasing.
Okay. Okay, sir. Sir, am I audible? Is my video clear to you?
It's little cracking, not
Okay.
too much clear to me. Shall I turn off my video if there is some issue with that?
No, sir. I think I don't. I think only the both of us have turned on video. I don't know which one is the problem, whether my connection or your connection. But
Right.
I'll move ahead with the next question, so you can answer the next question. So,
Okay.
how to develop a career as a financial advisor?
Actually, that's a very interesting question. So, I think the first win is like if you're thinking about that, that is definitely a first step towards that. And I'll suggest like financial advisor is a big field as such, right? You have to first think through how what particular area are you talking about. you know are you talking about being a financial advisor, maybe financial consultant in an MNC, or maybe a financial advisor in an Indian equity firm? So you have to decide that first, and routes are different. One thing that is common is to you have to get a good finance degree, and I think it could be, obviously it could be CA or CFA or MBA finance, like from a reputed college. So getting up a getting a good degree is the first thing, a bar for that. And then again, you have to acquire skills, right? Maybe focus on modeling, focus more on the valuation thing, right? So you have to choose your field, get a degree, get skills in that, and then the market is yours. You can definitely make your own decision and make your career in that.
So, to summarize it, we will develop the skills and then we'll let the Audience decided for us. We'll have a market for ourselves, place for ourselves. That's a
Definitely,
financial
definitely.
advisor.
So it's don't a destination, it's a journey. Like you have to get started, get on that. You might make some mistakes in that, but you'll ultimately learn, which area you want to go into. Again, finance is a bigger thing, valuation is one thing, M&A is another thing. There are different areas. So I think along the way you'll decide where you want to go, and you can tweak your paths accordingly. But getting a degree and then focusing on skills is the primary thing that you can do at this age.
Yes, sir. We got it. Okay. Next question. Quantity versus quality of stock, which is more detrimental and in what cases?
Okay. I think your voice was cracking, but I get it. It's more of like, if like whether quality of a stock is more important or quantity of stock is more important, right?
Yes, sir.
Yeah. So both are equally important. There's no clear winner in that, and it's the same thing basically. Some of the things that you can just put into numbers, other thing that you can't put into numbers. But ultimately, both things convey a message. Even if I do quantitative research, it tells me a story. What numbers are telling me about that particular thing. Then qualitatively, you have to go through management commentary. You have to go through research reports, analyst reports, industry reports. They will tell you a story. So both of the things are telling a story. You have to definitely do both all together. You can't rely on any one of that. And then, if it is resonating, the qualitative story is matching with the numbers, right? Then you have the right stock in place, right? For example, if a CEO is saying, we'll grow at a 25% CAGR going forward, but the numbers are not kind of resonating with that, then there is some issue. But if numbers are resonating, both things are telling the same story, then I think there's no issue with that. Both are equally important. You can't choose. So they are complementary, not a kind of substitute for each other.
Okay, 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 sir. So they've asked a question. Can you please suggest companies to work as a CFA level 3 candidate?
Okay. Again, it's CFA will definitely get you an entry into finance field, but which area you want to explore is something you have to come up with, right? Whether you want to go for maybe you want to be a quant trader, or you want to be a strategic consultant, or you want to be M&A consultant, you want to be going for an Indian company or for MNC, right? You have to come up with that first, and then accordingly there are companies that you have to choose for every field. So no single answer there. This company is good, this company is bad. So it's dependent upon everyone, right? Upon their level of interest and their area of interest, and you have to choose your company accordingly. And again, working in an MNC doesn't guarantee you are working. It's fulfilling for your experience, right? You might get more fulfillment while working in a small company because you have more power there, right? So ultimately, it's a very personal decision. There's no right or wrong. You have to get your decisions.
So it totally depends on the field that the individual wants to choose, narrow down to.
Definitely.
Okay, so how to gain short-term little gains? Like, should we have to reinvest those returns that we gain, like short-term gains?
Okay. So what I understood is, if we have booked some of the profits, how we should reinvest that. That is broadly I'm getting from that. And if that is the question, the answer is definitely you should invest, but don't wait for the same stock to invest. There are a lot of stocks in the market, and there are daily news stocks coming up. There's always some opportunity. So don't fall for, I have to go for unlisted stocks. I'll have to go for this. First explore what is available on the table. You'll definitely find some of the good opportunities. Start investing in that. And I always keep shifting money. When I think, a stock has reached my level of expectation, I book money, I shift it to some other. I already have 5 or 6 stocks lined up. When I free up fund from there, I shift it to those stocks. I hope I'm able to answer that. If that was the question, first of all.
Yes, sir. So, yes, sir. I think you answered the question. Okay, I think that is the end of Q&A session, guys. If you have any questions, please post it in the chat box. Meanwhile, right now we have a Q&A session. I mean, we have a quiz session for which I will give a message in the message box. There will be a Google Sheet, and you have to fill up that Google Sheet. We will choose a winner based on the Google Sheet, based on the answers that you gave in the Google Sheet. So quick, click the link in the message box and fill up that Google Sheet to win the quiz. And it's going to be very easy. Take the courage, take the step, and go and fill up the Google Sheet, guys. So in the meanwhile, I have one last question.
Yeah, please go ahead.
Is there any particular channel or any source that you obtain your information from, or is it always research that you use to back that stock? Or if there is any particular channel that you get your information from, maybe a YouTube or subscribing to a newsletter, anything like that that you would suggest us to follow religiously?
Yeah, definitely. So I while I do basic fundamental research for my own, and I actually I have my own newsletter and channel for that. But it doesn't stop you from referring to others, right? Definitely, there are a lot of good information in the market, and some of the YouTube channels are very good. They provide you very good information. While I can't name, okay, this is good, this is bad, I think that will be unfair to those I didn't mention here. I think go explore everything. It's not about sticking to one person, their methodology, or even sticking to me, right? How I think. You might have your own methodology, you might have your own way of thinking, which might be better than me, right? So my only answer is explore whatever you can, whatever make you understand. Some might talk in funny language, some might talk in very intense language. Find your own niche area, what suits you, and then you get your answer. There's nothing wrong or right. You have to choose what suits you best. And even I do the same. Having my own channel doesn't stop you from learning from others, right? So I refer to a lot of channels, a lot of videos, how they think about it. I borrow some of things from them, right? And this is how it works. I am not ashamed of that thing. Like I like saying, like I learned from a lot of my colleagues, so that is perfectly fine for me.
Guys, for those of you who are there in the audience, Sir has his own newsletter. You can subscribe to it to directly learn from whatever he is going through currently. And he, right now, I mean, you would have known he has taken us to all the insights that he uses practically in order to invest. And thank you so much, Sir. For those of you who are here, if you want to have a look at what Sir has said us, if you missed a little bit of a part here and there, we will be posting the recording in the YouTube channel, so you can go back and check it out. And I hope you have taken good notes of whatever Sir has told us. To summarize it, he told us to start early, to start investing early, to understand the company, and to have a 30-second rule of why should I invest in, why have I invested in this company. That is the second rule. The third rule is everything has a price and check the price tag, and always use PEG ratio in order to check the growth. And fourth one, FOMO is not a strategy. And when you have JOMO, you have a choice. FOMO is just fear. So don't act on it. The fifth one is the silver bullet. So it's still is a pretty big point, but if you want to know what is happening right now, track the smart money, track where all the private equity firms and others, the smart investors invest, and that will be a quick road for you to choose whichever stock you want. That has been the message for today, guys. If you have any more questions, please put it in the chat box. Meanwhile, Karthik, I think they are having a glitch in answering the quiz session. Okay, I think Karthik is looking on to that glitch. Okay, give us
Like
5 minutes.
Srinidhee, you summarized it pretty well, and those are the definitely five lessons I would like to new investors to know, and I can share that presentation with everyone if it is helpful. And again, you guys can connect me on LinkedIn. I think I'm already connected with a lot of people from the group, and you can ask me any questions, and I'm more than happy to help. if I can.
Yes, sir. So do you offer private portfolio services if someone asks you to?
No, no, nothing as of now. And
Okay.
I just do it out of my interest at my personal level, but maybe in future I might delve into that.
Okay, so looking forward to your growth in that.
Thank you so much. Look forward to that.
So, do you think that 100 minus age rule really works? Should we really take risk and invest in equity more than gold right now, like you mentioned?
Sorry, your voice is cracking a little. I'm unable to understand.
Am I audible now, sir?
No, I'm still not good. I might have to turn off my video maybe. Let's try now.
Am I audible now, sir?
Yes, yes, you are.
Okay. Do you think that 100 minus age, that theory really works? Should we take more risk as youngsters investing, or should we just like put in a lot of money in equity rather than in gold? Isn't gold like a safe opportunity? You already answered that question, but somewhere in the conventional mindset, it still seems like a little scarier to put money into the stock markets.
Okay. So
Everything in the stock markets.
yeah, I agree. So like 120 minus your age, it's a thumb rule, right? It's not a hard and fast scientific rule that you have to put. It depends upon you. It just give you an indication, how much approximate amount of money you should invest in this thing. But I personally think with gold reaching at this level, it's also going to be volatile, right? You might see, nowadays you see, okay, one day gold is 3% up, other days it's 3% down. This level of volatility we have never seen in gold, right? So again, this might be gold might be at a risky stage now. It's not that prudent that it used to be, especially when it's trading at this much of valuation. So you can't put gold and real estate into the safest asset as of now. They are also getting risky. And to your question, like, should we focus on stocks? I personally think you should definitely focus on stocks. And again, coming from the point, your family must have already invested in real estate and gold in some shape or form. So it's definitely wiser to invest in stocks. And there are some benefits as well. For example, stocks are very liquid. You can sell them one day, next day you can get out of it. There are some issues with for example, real estate. It has, first of all, it's very high ticket size. You can start with maybe 500 rupees in stock market, but real estate you has to come up with maybe lakhs or at least crores if you're buying something in Gurgaon, for sure, right? Second, it's very personalized investment. It's not standard investment, right? One house, maybe one building in one particular area might have a different price than similar house in maybe 5 kilometers away. But it doesn't happen with stock. Stock is a very standardized assets, right? So there are a lot of benefits that are associated with stocks. So again, from risk reward perspective, I think definitely at this stage you should focus more on the stocks than on gold and ETF, gold and real estate.
Okay. Okay, so I got it. We will try and take more risks at this age. Meanwhile, we have the next question. What is a good P ratio number, average P ratio number, bad P ratio number as per share market, and give us some examples of companies which have a good P ratio, average and bad. So they are somehow trying to get you name a stock. I think this is like a desperate question.
I get it. So again, P ratio is very much dependent upon the industry, right? So for example, if there are software companies, they might be trading at a PE ratio of maybe 60, 80, maybe 100. That's fine for them. So the industry which is growing itself, right? And they obviously deserve better PE ratio. As I given you example, IT is definitely one of the industry. Tech stocks, because they deserve better growth rate. They have better growth rate, so they deserve better PE ratio. At the same time, if you come to say maybe paper industry, right? So most of the stocks you'll find trading at 5 PE or 10 PE. You can't compare apple with oranges, right? You have to compare apple with apple only, like within that industry only. So the question is, like, for example, if you're tracking paper stocks, most of the paper stocks are tracking, trading at 10 PE, and then you find, one paper stock trading at 7 PE. That can be a good point to consider. It's trading below its peer average in terms of PE. Then you explore it further. Why it's trading? Is there any specific reason? So that is how it works, rather than comparing the overall PE ratio, or maybe asking for a particular PE ratio. You won't be reaching anywhere. You have to check for the industry. You have to check where peers are trading and how your stock is placed. And again, I
Okay.
can't name anything, so I am not alluding to any particular stock.
Okay, guys. Sir has already mentioned about PEG ratio. So we have our own research and find the own company which has better bad average PE ratio. That being said, we have the champions for today's quiz session. Congratulations, guys. Give me a minute, sorry. Really sorry, sir. I got a cough. Okay. Congratulations, Nidhi as Jain. You were the first place. And Karan Jain, you were the second in today's quiz. And Pravalika, you were the third in today's quiz. Your speed and accuracy really got you this prize. Congratulations, guys. Please DM us, DM Karthikeya in person in order to get your individual prizes. And sir, you made this Sunday really informative. Like you already mentioned, people are spending money this evening, and we get to level up our finance. And we've already heard this big quote: investing in ourselves is the best investment that we can make. And I think it was really a privilege to learn from you. You shared a lot of insights for me, especially a budding new investor, and my fellow CS students who shared a lot. I mean, who are also investing newly, and you patiently answered all of our questions, sir. Thank you so much. I hope really in future we can make money work for us much more than how efficiently we work on a Saturday evening as an article assistant. So thank you, sir. Thank you so much.
Definitely, it has been very enriching experience for me as well. I'm very glad to connect with budding professionals from my field, and I personally have a very soft corner for students. I want you to learn how to deal with finance. Don't get fear from it, and understand it, and then make wise decisions. And I think the future is yours. So it has definitely been great to be part of it, and would love to connect further if you want. So thank you so much.
Yes, sir. Thank you so much. We'll make ties with finance, and we'll learn from you. Like I already mentioned, you are a lighthouse. Like you already mentioned in your LinkedIn profile, you are a financial GPS who will guide us throughout. We will follow your newsletter and we'll learn more insights, sir. Thank you so much.
Greatly look forward. Thank you, everyone. Thanks for joining in. Bye bye.
Thank you, sir.
Bye.
Guys, there's also a YouTube link that is shared to you. Please subscribe to that YouTube channel. And thank you so much for joining. A big salute to all of you. You made this day really productive by joining this. Thank you, guys. Thank you, Kartikeya, for this opportunity.